Hey there, this is Alisado with Simple Option Strategies. Today I'm going to be talking about a loss that I recently had and how I managed through that, how I recovered, how I assessed and figured out what I did wrong in this trade. And then I want to talk about some of the rules that I have and what could go wrong really, really badly. And I want to see if I can help you avoid the kind of mistakes that some people have in managing a zero DTE trade and end up with catastrophic losses. That's what we never want to happen, and hopefully with this video prevent some of that from going on. All right, let's get right into it. So this is a screen basically of the trading day. The overnight futures were semi-positive, and so my plan was to put on a put spread, a bull spread. Just going to talk through some things that went wrong here. Okay, so first of all, I did wait for the market to go down some. A lot of times that happens. The market reverses from overnight trading, just people getting their profits. But on this day, as you can see here, it continued moving down. What I didn't really wait for the test. Generally, when you're in an uptrend or downtrend, the market will have a test of that low before it'll reverse. And so I put on the trade. I thought I was going to be fine. Looking back on it now, I didn't wait for this test, and it continued moving down. Not only did it continue moving down, it continued moving way down to about the 74 level, 73 level. And so I had identified some support at 77. It did kind of bounce here, but it was kind of the same thing as I had up here. And once I got down here, I knew that I was going to have to bail. Actually, I bailed right at the bottom of the trade. Have you ever done that? I looked at it, and when I saw the swoosh down here, I thought, man, I got out at the bottom. And so the other part that I look at on this is as I was trading here, you can see the RSI kind of going down and then coming back up a little bit. As the market was coming down, the RSI was coming up. And what that's called is divergence. Okay, so you have one indicator that's supposed to be kind of going along with the market in terms of momentum, and it wasn't. And so I was noticing that as I was trading and looking at the market going down, I thought, man, we have divergence here. It's only a matter of time that this thing is going to turn around, and it certainly did. Another thing I wanted to explain here is we call these pivots, right? Every time the market goes down, swings back, this is a pivot. Goes down, swings back, this is a pivot. So we had this pivot, and this pivot. When you're identifying a reversal and trying to pick a bottom, what you want to see is the market go up through the previous pivot. What happened here was I noticed that the market went strongly up, and we went out of under oversold conditions here, and I decided to basically put on another trade and take another opportunity here, right? So I put on this time a 60-55 spread, five points lower than the previous spread, and took a premium of 50 cents. Well, we validated the move up, continued moving up very strongly. Clearly was a reversal, so I put on another 10, and it moved up until it finally took the gain here at 10 cents. So I did take a loss of $750, which was pretty hefty, and made that back in the opposing trade while the market moved up. Made $700. So overall, I took a loss of $50, which was nice. It's not a bad loss. It's pretty good actually. But what I want to show you, and what's most important about this, is that this is the next chart, and this is basically the rest of the day and what occurred. This is the part that we just talked about here, where I put on the trade here, and I got out basically here, right at the end. And what happened after that was that we got a news event that just made the market tumble, and it actually went way past the loss that I took down to the 2560 range. What I want to say is that when you're trading zero DTE, one of my rules is I never let a trade expire. I always take profit on it, and the reason is because you don't know what's going to happen throughout the rest of the day. Another 4 hours, 3 hours in a trading day is a very long time for zero DTE. What it is that all this time here compared to this time when I was in the trade and got out is risk. This is basically time is risk, and you need to remember that. So any time that you're in a trade, you want to be looking to get out of that trade as soon as possible. The other thing I tell those that I trade with is allowing credit spreads to expire worthless is not, it's just not a good strategy. It's not. And so if you're going to take on this trade, I implore you to make it one of your rules to not let the trade expire and to get out when you have your profit and call it a day. So my trade day ended at 11 o'clock. Even though I took a loss, I did recover from it. Losses are normal. It happens. I'm used to them. And so I can recover pretty quickly from it psychologically, just because I know there's going to be opportunities here. I trade this 3 days a week, and I've done this for a year and a half now. But again, always remember, time is risk, and you don't want to let these things expire. Okay? Subscribe to my channel. I put out these videos every week. You're going to learn. I'm going to share all the information I have about trading and trading this successfully. I'm very consistent at this. My win to loss ratio is about 80%. And so once you trade this thing and you have your rules down, it's a very, very favorable trade. Just want you to be aware of the dangers. All right, subscribe to my channel. You'll get a video every week. Hope you enjoyed this one. Hope and value to you. Have a great rest of your day. Thanks. Bye.